All right, so welcome back to another session, Money and Banking. So now that we have a fairly thorough understanding of bond markets and how interest rates are determined and how bonds are priced and how they calculate yields to maturity and about the term and risk structure of interest rates, we can turn now our attention to a second key financial asset, which is the stock market, right? So this is a fairly rudimentary introduction into stock valuation, into the workings of the stock market. Given that the course is a broad overview into money banking and the financial system, we don't have like a lot of time to spend on going into the technical details of how stocks are valued. It's very fairly complicated. Once you go beyond the basic theory and the basic pricing equation, but we'll still introduce the key ideas in stock market valuation, how to think through issues in the stock market. Okay, so let's get the ball rolling. So we'll talk about five key ideas here. The first thing is to first describe what we mean by the stock market. What is a stock? What is a share? How does the stock market function? Then we'll talk about the most fundamental notion of how do you determine what is the fair price of a stock, right? How do you value a stock? Then we'll talk about what is known as the Gordon growth model, which is the usual basis of understanding stock valuation. And then we'll talk about how a dominant theory of the efficiency of stock markets has taken hold, right? So in 2017, Eugene Fama, a very noted economist at the University of Chicago, won the Nobel Prize in part for his work on the efficient market hypothesis, right, which he proposed during his work in the 60s and 70s. He's a strong proponent of this idea. But over time, this notion that financial markets are efficient has started to come under some strain and fairly well-founded criticism, and most of it comes from the behavioral finance literature. So that's what we'll do in the last three parts of this, is to talk about what the efficient market hypothesis has to say about stock market pricing. Then we'll talk about what the fundamental weaknesses of such a theory are, and then we'll rehearse some of the core challenges that behavioral finance have thrown up on this issue. Okay, so that's the big roadmap. So after this, you should have a understanding of what we mean when we talk about the stock market. How do you value? How do you price a stock fairly? What is the efficient market hypothesis, and how is it undermined by new forays in behavioral finance literature? Okay, all right. So here's the story. We'll get the ball rolling by looking at Apple stock. Okay, so this is basically up to June 2016. You can continue. I mean, there's been stock splits in Apple stock and so on and so forth after this, but the basic story still holds up, right? So in April 2000, Apple's share price, if you looked at Apple stock, Apple has been publicly traded since the 80s. Late 80s is when they went public as a publicly listed company, went through an IPO, but they've been trading as a public company for over a decade at this point. But if you wanted a partial ownership stake of Apple, you could buy for $4.08. That was the trading price. So if you had $1,000 worth of 1,000 shares worth of Apple stock, if you had to buy them, that would be worth about $4,080. So if you had to sell them, that would be worth $4,080. Okay. Now, by June 2016, the same 1,000 shares that you bought in, if you had bought into Apple in April 2000, the same 1,000 shares that you bought for $4,000 would be worth $95,330. Okay, and as you can tell, the path has not been very smooth, right? There has been. It's not just okay. You look at the when people run this kind of um, thing in a financial press, they'll say, oh, if you bought like $1,000 of this thing or that thing or the other thing in 2000, it would be so much. And it's very easy to say that in hindsight, right? Once you know how the story pans out, it's very easy to, as they say, Monday morning quarterbacking, where the game's done, you know all the errors, you know what the path of the game was, and then you could say, oh, they should have done this. And that's interesting. It's analysis, and that's reasonable. But the point that a lot of people miss during this is that the intervening period is one of volatility. It is not like a straight path that the Apple price stock starts at $4.08 and just keeps shooting up. Because if you bought Apple stock in April 2000 and you were fairly confident, by December 2000, the stock price had crashed over 75%. It fell to 98 cents for a single price. Your position that you bought for $4,000 would be worth barely $1,000, right? And then by February 2005, the stock price was just wavering in that region for a long time. For 5 years, you're looking at a stock which is just moving in that single digit range, and it would be worth $5,900. After 5 years, you made like a $2,000 profit, which is not nothing to write home about. But if you had held on to that position for longer, by the time the first iPhone came out, the stock price had appreciated significantly, right? If you had the wherewithal to see that far into the future and imagine in 2000 like a product like the iPhone would come out, which would revolutionize the world, and everyone would have a smartphone, and if you're able to predict with that kind of precision, that's a different story altogether, and I would like to talk to you about this. But generally speaking, we can't see, with the future is full of risk, right? But the point I'm trying to say is that, yeah, the returns are going to be good, are good for Apple stock, but there is also, the entire period is also one of a high degree of volatility with when you mark your positions to market, which is to say you take 1,000 shares and look at how much you could get for those 1,000 shares in the market. That's what we call mark to market positions. You could see that there's a lot of volatility involved. Okay. Now, this has been the case. This is, the Apple stock is well covered, but this has been the case for the stock market in general. Right? Volatility in the stock markets have become a little bit more pronounced in the last 15 years. And the question then arises, does the increase in volatility affect willingness of investors' willingness to be invested in these stock markets? Okay. So the key issue that we'll try to get to the nub of by the end of this discussion is that we know stock prices go up and down, and there's a lot of volatility. There could be large swings in stock positions. And the question is, does the stock market affect the broader economy? Right? We are not just primarily concerned with stock market in general. We are not fine. If you're a finance major, perhaps you're concerned with the stock market in general. But as economists, we want the whole picture. We want to know how the machinations inside the stock market affect and ripple out to the broader economy, and what does that have to do with consumer welfare and so on and so forth. Okay. One thing that I would like to note right at the outset is that, the way financial press covers the stock market, it almost seems like they believe the stock market is the economy, when in fact the stock market is only a small portion of the economy. So don't confuse those two things ever, right? The stock market is an indicator. It's merely an indicator of the overall health of the economy. Yes, once we get into discussion, we know that the performance of the stock market is correlated with the performance of the economy, but that's basically it. There is a correlation between these two things, but one is not a substitute for the other, and that's a crucial thing to recognize, right? Just by looking at the S&P 500 numbers or the Dow Jones index or any other index, the Russell index, whatever index you want to choose, or the national index of a particular country, that is not a sufficient indicator of the overall health of the economy. It's merely one among a wide array of indicators that we use to assess the broader health of the economy. So I guess I've tipped my hand that straight away as to whether I think the stock market affects the economy. The answer is clearly yes. The stock market has ripple effects into the broader economy, but the stock market is not the economy. Okay. All right. So let's get into it. So let's talk about the basic operations of the stock market. And before we get into it, we have to first think about what a stock represents. What do we mean by a stock? Okay. A stockholder is basically a part owner in the firm, right? You have partial ownership in the firm. So as with any firm, if you have some ownership stake in the firm, you're entitled to the profits of the firm, to a portion of the profits of the firm, right? So you and your friend get together, You start a business, you're 50-50 partners, suppose it took $10,000 to get the business off the ground. You contributed 5 grand, your friend contributed the other 5,000, and you run the business. So any profits that you realize, what is the profit sharing mechanism? You share them 50-50, right? It's the same story. If you buy a share of Apple, you're entitled to a portion that is represented by the share in the Apple, that fraction of ownership that is represented by the share in that firm, and you're entitled to that share of the profits from the firm. And when we talk about profits, very simply, we're talking about the difference between the assets that the firm owns minus the liabilities that the firm owes, right? The difference is what we essentially calculate as profits. So stocks you would also often see as equities. They're usually referred to as equities as well. There's a lot of names and jargon which floats around these markets. And equities, they're called equities because they represent partial ownership stakes of a firm. Okay. So what makes the evolution of the stock market, if you look through the history of the stock market, there's a wonderful book by Niall Ferguson called Ascent of Money, where he also traces the history of the stock market. The idea is fairly straightforward, right? Not that long ago, most businesses were, and not even right now, most businesses are held as small proprietorships, right, or small partnerships. So proprietorship is just a sole owner, right? So you own the firm and you have unlimited liability for the firm's debt. So if your firm goes bad, your personal assets, the assets that you personally own, can also be used to repay the people who lent you money. Okay, so that's the notion of unlimited liability, and the sole proprietorship is a very risky business in that, right? So you have one bad year, you can't repay your debtors, and they can come after not only the firm itself, but they can come after the personal finances of the firm's owner or the proprietor. Now, the evolution of this business model was into what is known as a corporation, right? A corporation has this nice little advantage of what is known as limited liability. So if the corporation does poorly, all of the firm's assets, all of the corporation's assets are fair game in order to recover your, if you lend money to a corporation, like let's say for in this current climate, J. Crew, a large retailer, has gone bankrupt, right? They filed for Chapter 11 bankruptcy protection. Given the coronavirus pandemic, J. Crew's business had already been suffering for a long time before then. But given the pandemic and the fact that there was the retail spaces completely dried up, there's no one going to the stores to shop and all of that, J. Crew filed for bankruptcy. Now, when J. Crew files for bankruptcy, it says that our assets are not sufficiently large enough to cover the liabilities that the firm has, right? The firm owes more money than it has in the form of assets. Now, the firm's debtors, J. Crew's debtors, can go after all of these assets, liquefy. Okay, so J. Crew owns a bunch of stores. You can try to sell these stores off, recover some cash from it, and make yourself whole and do all of these things. But you can't go after the CEO, the COO, any of the corporation's employees on their personal balance sheets. You can't go get the CEO's house or the CEO's yacht and then use that to make yourself whole, right? Because those are personal assets and those are protected from liability, and that's the notion of what we call limited liability. Okay, so corporation is a legal form of organizing a business where it provides these owners with the protection that you will never lose anything more than what you invested into the firm, right? All your personal assets are shielded from debtors, so only what the firm owns and the assets of the firm. And to purchase these assets, obviously you put in some of your own investment capital, and all of that is fair game, but none of the personal assets of the firm's operators are in play. Okay, so that's the evolution of moving from a sole proprietorship into what we call the corporate structure and into what is now the most dominant way of organizing business, the limited liability corporation, right? So even if you're going to operate a small mom and pop store, it is prudent to set up the ownership of the firm in such a way that a limited liability corporation owns that store, and in turn, you control the limited liability corporation. right? That is just a way of just adding some protections into the mix so that if the business goes bad, you're not personally exposed to it. Okay. Now, why would anyone want to own a stock? And the answer is very straightforward. You own a stock because if you own a share of the stock, you're entitled to a portion of the profits of the stock. And one way that these profits are distributed is what we call dividends, right? A dividend is a payment that a corporation periodically makes to its stockholders. And one big element of a dividend is the fact that it's completely discretionary, in the sense that the firm decides first whether or not they're going to pay a dividend. So the firm is not obligated to pay a dividend. And if it does decide to pay a dividend, it can decide on the size of the dividend that it wants to pay. What share of the profits does it want to send out of the firm? And kind of makes sense because historically, firms were, if the firm made a profit, they had to distribute all of that profit back to the shareholders. And then the shareholders could decide whether they wanted to reinvest some of that proceeds of those dividends back into the firm. Now, the problem with it, as we'll see, is that there is a tax liability. There's a double taxation of dividends problem. So we'll get into that in just a few moments. But the idea is that if the firm is growing and you don't need immediate access to the cash, the profits that the firm generates, it might be more prudent to reinvest the profits of the firm back into the business itself. That you don't want to draw cash out of a growing business, that you want the people who are managing the business to take the profits and invest in other opportunities and continue to grow the size of the business. Okay, so dividend represents a, a payment that a corporation is going to make to the stockholders, and there's usually two types of dividends, right? There is what we call a common stockholder and a preferred stockholder. So a common dividend or just dividend, and a preferred dividend. Okay, a preferred stock is a very interesting idea. A preferred stockholders receive a fixed dividend, right? In a certain sense, it operates almost like a debt instrument. In the sense, if you lend money to a firm, you're entitled to periodic interest payments from the firm. So preferred stockholder is almost like you have a debt position where you get a preferred dividend payment, which is to say a dividend payment which the firm can't miss. Right, so there are legal remedies if the firm misses that dividend payment. So in a certain sense, it operates like that. But at the same time, you also own a partial ownership stake in the firm, right? So preferred dividend gets like the best of both worlds. A preferred stockholder not only gets a guaranteed dividend in every single period that the firm is operational, but at the same time, they also share on the upside, right? That they also own a part ownership stake in the firm, which is to say they have skin in the game, that if the profits of the firm grow, the size of their preferred dividend, the size of their position in that firm also grows, and you can realize gains there. A common stockholder is the more, firms don't really like issuing a lot of preferred stock. Preferred stock is usually issued at the beginning of the lifespan of the firm when the risk is really high. So to mitigate some of the risk that is attendant to getting a business off the ground and running it successfully, you might get initial equity players a preferred dividend in order to incentivize their participation in the firm. For instance, when Facebook was getting off the ground, a lot of the initial investors came in with preferred equity positions, which is to say they would take a partial ownership stake. So let's say they invest so suppose Facebook was valued at $10 million. I would come in and put $1 million into the firm, and I would take 10% stake in Facebook. At the same time, Facebook promises that out of the revenues that they're generating, they're going to pay a small dividend, a preferred dividend to me, in order to just make sure that some of my money is coming back. I'm recovering my money a little bit quicker that way. But common stockholders don't have any of those things. Right? Common stockholders is you and I, the retail investors who are invested in the stock market. We don't have any preferred equity positions. All our stock is common stock, which is to say that the dividend is not guaranteed. It doesn't even have to be paid, and the size of the dividend depends on what the management of the firm decides it will be. So that there is a lot more, as the profitability of the firm fluctuates, the size of the common dividend is also going to fluctuate along with it. Okay. So when we talk about the market cap of the firm, the market capitalization of the firm, or we essentially are talking about the value of the firm's, the sum of the firm's common and preferred stock, right? What is the value of the common stock, or what is the value of the preferred stock? You add those two things up, and that's how you arrive at what we call the market cap of the firm. Okay. Now the question is, okay, so we understand what a stock is, why you might want to own it. The question is, what kind of stocks can you actually buy? And there is a difference between what we call, public equity and private equity. A publicly listed firm is what we generally refer to as a firm on the stock market, is open to the general public, which is to say, if you want to be a part owner of Tesla today, you can just go into your stock trading app or your stock trading uh, platform and place an order for a share of Tesla, and you become instantly a part owner of Tesla. So it's publicly listed, which just means that it's available to anyone and everyone to become part owners in the firm. Okay. Of the 5 million US corporations, there's more now, let's say 5.2 million US corporations, legally incorporated entities in the US. Only 5,100 of them, and this number has been coming down over the decades, are what we call publicly listed. So only a small fraction of all the businesses, all the legally incorporated corporations in the United States trade on the public markets, a very minuscule fraction of them, right? And there's a reason for that. It's very expensive to be publicly listed, and you come under the scrutiny. The regulations around publicly listed companies are much more severe. You have to periodically, every quarter, you have to declare your results. You have to make sure that your company's financials are audited by an independent third party and that they are certified and published, and the financial press covers you. You come under a lot of public scrutiny, and politicians are going to pass regulations based on what is happening. And there is a lot of this involved. The advantage is obviously that you have a large pool of investors to draw on in order to raise capital for any kind of business related activities. On the other side of the spectrum, the rest of the 5 million corporations which are not publicly listed are what we call private equity, where the ownership of the firm is limited, right? It's limited to a small group of people. If it's a proprietorship, it's just one person running the show. Other things might have 3, 5, 10 owners, but it's all private equity. It's not open to the general public to invest in these firms. They're limited to private individuals, okay? So the New York Stock Exchange is the most well-known example of what we call a stock exchange. A stock exchange, in its historical sense, was a physical location where you would go to trade these pieces of paper that you call shares, right? So the New York Stock Exchange, if you go down Wall Street, where the original New York Stock Exchange is, there's a big tree right around the corner, and that's where the first kind of stock exchange was formed. Which is to say, what people thought was that, okay, I own some portion of this firm, you own some portion of this firm, I think your firm is pretty good, you think my firm is pretty good, and we come together and we're like, okay, let's trade some of our stakes in these firms, right? So this is the origin of a stock exchange. With the stock exchange, the story could end where you buy a partial ownership stake of the firm, and that's it, right? And that's it. That's the end of the story. The firm makes profits, they'll pay a dividend, and if the firm goes under, your position gets wiped, and that's basically it. A stock exchange now allows us to trade these different ownership stakes we have in different firms with each other. Okay. So a stock exchange, when you talk about stock exchange, traditionally it's a physical location, but over time, of course, with the advent of network computers, we have just completely computerized. Most stock trade, very a small, minuscule fraction of stock trade actually happens on the floor anymore. It is all run through a network of computers, and that's what we call the over-the-counter market. Okay. So an OTC market, if you see this phrase anywhere, the OTC market is basically, there is no physical location for the stock exchange. All of that transactions, all of the exchange is going to happen over a network of computers. And the NASDAQ is the biggest example of this. And there's no physical NASDAQ location. NASDAQ has offices, right? Offices from which they manage these computers. They have teams and employees and all of that, but there is no physical location. You can't go to the NASDAQ office and say, I want to sell a share of Apple, and they're going to be like, okay, go on the computer and do it. Okay. So even though New York Stock Exchange is still a physical exchange, most of the trading now there is also electronic. And here I have like here you can see how dominant the NYSE is in the global stock market, right? So the NYSE, about $20 trillion worth of shares are listed on the NYSE. The next closest one is the Nasdaq with about $7 trillion worth of assets listed there, and then you can go through Tokyo's Japan Stock Exchange is the third. Euronext is for Europe, London Stock Exchange, the Hang Seng, the Shanghai, the Toronto, the Shenzhen, the Deutsche, and so on and so forth. Right. So these are all exchanges in the major financial capitals of the world. And you can see that the NYSE, there's a reason why New York is the financial capital of the world. It is home to the two largest stock exchanges in the world. Well, the biggest OTC market, the over-the-counter market with the Nasdaq, and the physical stock exchange at the NYSE. Okay. Now, the third question is, how do we measure the performance of the stock market? Right. Every day, at the end of the day, if you if you watch the news or you pick up a copy of the Wall Street Journal or any financial newspaper, you're going to see basically reports on what the stock market has done on that particular day. Okay. So stock market index basically is reflecting the average, okay, of all of stock prices, right? So it's not about just what a particular stock did, right? It's not just about what Apple did. So you can look through that as to what each company which was listed did, but you also want a whole composite picture of the overall performance of the stock market on any given day. And that's basically where you look at the average. It's not a simple average. You average them a market. It's a weighted average. It's a weighted average by market cap, right? So you don't just so the largest companies carry a bigger weight in the index, but basically it's a weighted average of all the stock prices, and you use that as a parameter for the performance of the overall stock market. Okay. So indexes, by definition, when you look at an index, they don't have any kind of units associated. They're not dollars or anything like that. They basically, you set some date as when the index is set at 100. That level of the stock market is set at 100, and from there on you see fluctuations. Did it go above 100? That means the stock market rose. Did it fall below 100? Which means the stock market fell. Right. So the values of these numbers that you see are not meaningful, right? So when they say, oh, the Dow tops 30,000, I like, or these S&P crosses 5,000 or whatever it is, the number itself is completely meaningless. What matters is that the relative changes, the percentage changes in their values. That's what's important. Okay. So for instance, here, here we have the three biggest indices that get reported in the financial press: the Dow Jones Industrial Average, the DJIA, the S&P 500, and the Nasdaq Composite. Okay. Now the DJIA, it basically, as the name suggests, it's more a performance of industrial stocks, right? So it's taking a look at manufacturing and industrial stocks, and that gives an indication of what's happening in those sectors. The S&P 500 is sector neutral. It just is looking at the 500 largest companies listed on the NYSE and or on the stock market, and the Nasdaq Composite is just basically looking at the it depends on what the composite is, but it's usually about the 100 largest firms which are listed on Nasdaq. Okay, so as the time series suggests here, it is not some linear path, right? So if you looked at 1999 and then you looked at 2016, you would say, yeah, the stock market has grown up. But the point is that in between, there's massive fluctuations, right? There's periods where the stock market just moves sideways, so it's just like that. And then in periods of recessions, the stock market might fall. And here we have the 2007, 2009 NBER shaded recession, where the stock market fell off a cliff, right? So this change is what matters, that the stock market, which started at the level of about 14,000, falls to about 7,000. The change is about 50% drop in the stock market. That's what is important, right? So it's the same things here. So, the raw numbers themselves are not meaningful. It's just the changes that we want to see. So I want to impress those two things on you. The fact that the raw number, the level of the index doesn't really matter. It matters as to what the level of the index is relative to some other point in time. Okay. The other thing to note is that there's no linear growth in the stock market. It's a very volatile process. So there's going to be periods where the stock market goes up. There's periods where the stock market comes down. There's periods where the stock market might just move sideways, which is to say, it doesn't go up or down. It just is, just fluctuates around some thing. Okay. All right. And the question then is, do these fluctuations actually matter to the broader economy? Okay. The answer is yes. Okay. The short answer is yes. These fluctuations actually matter to the broader economy, but the answer is a little bit more nuanced than that. The stock market doesn't directly affect household consumption, but it affects it through an indirect channel, right? So you park your money in your stock portfolio, or you have a 401k, a retirement account, and suppose the stock market does well. So the size of your 401k or your stock market portfolio goes up. That translates into what we call a wealth effect, right? You're feeling wealthy. You have, nominally on paper, you have more money than you had before. So you would be more willing to spend money. So your consumption is correlated with how wealthy you feel, and households spend more when their wealth increases and less when their wealth decreases. This is what we know as the wealth effect, that uh, there's an indirect relationship. So if we see the stock market rise, the natural uh, analysis then leads us to know that household wealth is rising, which is to say that it will have an effect on household consumption. If it has an effect on household consumption, it will have an effect on the demand for goods and services. And that's what we are concerned with as economists, as to what is affecting the demand for goods and services, and what is affecting the supply for goods and services. Okay. On the other side of the market, I'm sure you've all gone through an intro course where we view the economy in the circular flow diagram as households on one side and firms on the other side. So there's effect on firms as well. Corporations rely on these stock markets as a source of funds, right? So a project comes up, you're a firm, a project comes up, it's a promising project, it costs $100 million to get this project off the ground, and you need to secure funds to get this off the ground. What are your options? You could go to a bank, get a loan, or and if you go to a bank and get a loan, that's fine, but the point is that you have to make interest payments on it, and this project might take a long time for it to pan out and pay off and all of those things. In the meantime, you might struggle to make those interest payments, and if you struggle and at some point can't make those interest payments, the bank can seize that asset and try to make itself whole, and that's a whole other can of worms. The other option is to just go and sell some of the firm's ownership, right? So suppose a firm is worth $1 billion, its market cap is $1 billion. You can go for you can issue stock for about 10% of the firm. You can sell 10% of the firm's ownership stakes and raise $100 million from them. The advantage to that process is obviously that you don't have binding obligations. It's not preferred stock. Suppose it's sold as common stock. So if the project actually works, then you make a dividend payment. And if it doesn't work, it doesn't work. The equity holders know that there is a risk involved with it, and the firm is better off. So if the stock market fluctuates, if the stock market is doing well, that indicates that there's a lot of demand for stocks and these assets in the market, which makes it easier for firms and corporations to raise capital in order to get new investments off the ground. At the same time, when there's periods of financial distress in the markets, that makes the stock market tightens, and which means that the flow of funds to these corporations begins to get constrained, what we call a credit crunch. Okay. All right. So that's basically what I like here for you to see, that on the first panel, this is an index of stock prices, right? So August 1929 is where the stock price, S&P 500 level is set to 100. So everything is measured relative to what happened on the eve of the Great Depression. So we have that as the indexing thing, and we are using the third quarter real GDP, same thing, August 1929, third quarter real GDP. So we have the same base thing. So it's important to make sure that these bases are aligned. Otherwise, you might get very spurious results, right? The base periods need to be the same. All right. So what do we see? We see the stock market had a massive run up in the 1920s. Is what's referred to by, if you know your literature, by F. Scott Fitzgerald and the Great Gatsby as the Roaring Twenties, where the stock market went on a meteoric rise. Again, these numbers don't really matter; the change matters. So a stock market which the index was at 25, the index breached 100, which is to say the stock market went up 4x, which is a 400% increase in the average stock market prices. Okay. And then this Great Depression came, and then there's a massive crash in the stock market, right? This is Black Friday, October 29, 1929. This is when the stock market collapses, and where the index was at 100, it fell to below 20. So about 80% of drop in the average stock market prices. And then there's a period of recovery and so on and so forth. The crucial thing I want to show you here is that in the same period, if you follow the real GDP, when the crash happened, there is an effect. Okay, when the stock market was going up, the real GDP also was going up, right? But if you look at the slope, the stock market goes up on like a massive tear. The real GDP goes up, but slowly. Okay, the stock market crashes with a massive bang, but the real GDP falls, but slower. That is to say that there is these two things are correlated. That if the stock market is rising, chances are that the overall economy size of the economy also rises. If the stock market crashes, chances are that the real GDP will also fall, but they are not perfect. They're not perfectly correlated, which is to say if the stock market falls by 20%, the real GDP doesn't fall by 20%. It always, nearly always falls by less than 20%. The stock market goes up by 20%, the real GDP doesn't rise by 20%, it almost certainly will rise by less than 20%. And that's the crucial thing to recognize, that the stock market is not the economy. The stock market is correlated with the economy, and the economy is correlated with the stock market, but they are not perfect substitutes for each other. Okay. So when we get into the final leg of this course, and when we talk about financial crises in general, we will use the Great Depression of 1929 as a case study. And here I just want to rehearse two common arguments, and by the end of the course, you will see what side of the argument I fall on. And it's always, as I say, it's usually more than one thing, right? Occam's razor, that the simplest explanations, the best explanation doesn't always really hold up. The situation, the explanation is always a little bit more complicated than that. Okay. So John Kenneth Galbraith and Christina Romer, two very, very well-respected macroeconomists, argue that the stock market crash in October 1929, right? So when we look at the history of what caused the Great Depression of 1929, they argue that the crash not only reduced wealth because the size of your stock market portfolios went down and consumption spending, but it also increased the severity of the economic downturn by reducing confidence, right? So if the stock market is beginning to collapse, it is the most watched indicator, and that plays into the fears about the future, right? Even though your personal finances might not be that adversely affected, just by the mere fact that the stock market is collapsing introduces a degree of trepidation and fear and inhibits participation in the economy. And that's their explanation, that it was so severe because not only was there was an effect on wealth which reduced consumption spending. Not only were a lot of people losing their jobs, unemployment skyrocketed to 25%, which is the highest we've seen till the coronavirus pandemic, to be honest. But uh, the unemployment was at 25%, which means a lot of people were out of work. So consumption spending was coming down because of that as well. But also it undermined the confidence in the functioning of the economy. And that between all three of these factors, very potent forces, the Great Depression continued on till the eve of the US's participation in the Second World War, right? On the other side of the story is Milton Friedman and Anna Schwartz, his long-term collaborator, who have argued that it had nothing to do with the stock market crash, because they are talking about, their views, the stock market has only a passing effect on the economy. It has to do with the collapse of the US banking system during the Great Depression. Okay. The point is to say that, okay, is the same event, multiple different explanations are um, are obviously put forth, and the point of academic analysis is to sift through the evidence and see what argument has more merit. Okay, so when we get into the case history of the Great Depression, we'll get into all of these uh, in much more detail. Okay. All right. So let's turn our attention now to stock valuation. So we'll do very basic, simple stock market valuation. The reality is obviously much more complicated than what I present here, but this gives you an indication of how stock prices are determined. Okay. Yeah. The fundamental thing that I want you to really think about and take away from this course is, how do you determine the price of any financial asset? Okay. And the answer is always very simple. The answer is the fair price of any financial asset is the present value of the payments to be received from owning it, right? All we are doing is valuing future cash flows from owning this financial asset and discounting it into the present time to know what is worth in today's dollars. Now, theoretically, that is a very elegant, simple explanation for how to value financial assets. Any kind of financial asset anyone throws at you, you can price it by asking three fundamental questions. What are the cash flows? When are they coming through? What is the timing of the cash flows? And what is the discount rate that I apply to these cash flows? Now, it's in reality, all of these are very complicated enterprises. What are the cash flows? I need to know the cash flows into the future, and for that I need to rely on some measure of forecasting, and that's always somewhat error prone, right? I might expect to make $100 million in the next quarter, but I might miss and make 95 million, or I might overshoot and make 110 million. We don't know. I mean, we want our forecast to be as refined as possible that we don't miss it by that big margins. But the point is that knowing these cash flows is not always set in stone. Unlike bond pricing, where the interest payments are predetermined, which means that there is no uncertainty around the cash flows from it. You know that the interest payment is this much, you know what the face value of the bond is, and you know the timing of the cash flows. The only moving part there is the discount rate to apply on these cash flows to get to the bond price. So that's a much easier enterprise than valuing stocks. In stocks, not only is there uncertainty around the cash flows, there's uncertainty on the timing of the cash flows, because these dividend payments are discretionary. So you might expect a dividend next quarter, but the firm might decide not to pay out a dividend, which means that the timing of the cash flows is also suspect, and the discount rate that you apply to it is also it's some technical aspects of it, some art, some science to it as to coming away with a good discount rate. I will get into all of that as the course progresses, but I want you to understand that fundamentally asset pricing comes down to asking the question, what are the cash flows, what are the timing of the cash flows, and what is the discount rate I apply to it. That's, if you can answer these three questions with a certain degree of precision, you can come away with a good fair price for a financial asset. Okay. So what we call the required return on equities is the expected return necessary to compensate for the risk of investing in stocks. The RE that I've written here, what we call the required return on equity, is the expected return. First of all, it's expected return. It's based on a consensus view, more or less, on what stocks need to return for them to be worthwhile to carry the risk associated with stocks. Relative to bonds, if you're just comparing between these two financial assets that we've covered, bonds and stocks, with bonds, there's no uncertainty around them, in the sense that if you buy a bond and hold it to maturity, you know all the interest payments will come due, and that maturity, the face value gets paid off, and that's basically it, right? There's not any much uncertainty around a bond in that sense. But with a stock, it's riskier, because you don't know what the size of the cash flows are ahead of time. You don't know what the timing of the cash flows are ahead of time. You don't know what so you need to get compensated for the additional risk that you carry in investing in stocks. right? From the viewpoint of the firms, this exact thing, the required return on equities, is also called the equity cost of capital, right? What is return for you is cost for the firm. So uh, when you see these two terms, equity cost of capital or required return on equity, they're basically referring to the same thing, RE. Okay. So when we talk about the equity premium, this is what I've already alluded to. If you're just considering, if your choices are, do I invest my money in a treasury bill or do I invest my money in the stock market? The answer is treasuries are less risky, and they're less risky for the same reason I've already rehearsed, where the coupon payments are determined ahead of time, the face value is known ahead of time, so the risk involved is much lower relative to stocks, which means that you need to get compensated, as we already talked about. If the risk gets dialed up, you need to get compensated for it by a higher return. Okay. So the equity premium for an individual stock basically has two components. You need to at least compensate for these two factors. The first thing is what we call systematic risk. Systematic risk is the risk that price fluctuations in stock market affect all the stocks in the market. Right? So it's not about just one company's performance and one company's fortunes. Something massive happens which affects the entire stock market all at once. For instance, the pandemic that has been unrolling right now is a shock, not, it is a more severe shock to certain sectors and certain companies, less severe shock to certain sectors and certain companies, but it's a shock to the entire system nonetheless. So it's a systematic shock, and that's systematic risk. There's no way to hide from this risk. Okay. Idiosyncratic risk, or what we call unsystematic risk, is the risk which is associated with just one particular stock, the movements, the volatility in the movements of the price of one particular stock. Right. So your equity premium needs to compensate not only for the level of systematic risk inherent in investing in the stock market relative to the treasury market, but also needs to, when you go into a particular stock, that particular stock needs to be also, you also need to be compensated for carrying the idiosyncratic risk, the unsystematic risk associated with just that particular stock as well. Okay. So here's a clean example of how you would go about pricing these things up. Okay. So you expect that Microsoft will pay a dividend of 60 cents. All of the stock price is done in expectation. So crucial element, even though I put down firm numbers here, that's all like you're expecting. That's based on your projections, based on analysis, based on historical patterns, based on complicated computer algorithms, based on firm guidance, based on economic conditions. A lot of different factors play into this, but you form an expectation that Microsoft will pay a dividend of 60 cents. Okay. Expected price, you expect the price at the end of the year to be $32. Again, this is expectation. You are expecting stock price to be $32. Okay. The return you require in order to invest is 10%. So the required return on equity is 10%. So these are three firm numbers I put down with, like, don't, um, just because I put down numbers doesn't mean that these numbers are, set in stone and they're firm. These are all done in expectation. Okay. Now, the 60 cent number, where does it come from? 60 cent number, you could say, okay, Microsoft issued a dividend of 59 cents this quarter. Their business is not fundamentally changing, but they're growing slowly. So they might issue a slightly bigger dividend. So yeah, they issued 59 cents this quarter. Maybe they'll issue 60 cents that quarter. Seems reasonable. You're just going with historical data and you can come up with it. You don't even have to revise it. You can just say, oh, they paid 59 cents. I'm expecting them to continue on this trend. So they'll pay 59 cents in the next quarter. Okay, so maybe that's one way to form those expectations. Expected price of the stock is a different ball game altogether, right? That's, you do a fundamental analysis of the stock and come away with what the stock price you think will be in a year. We'll get into that in a second. And the return you require in order to invest is 10% is subjective to a certain extent, right? And it depends on what your next best alternative is in a certain sense. What the opportunity cost of investing in Microsoft is relative to other things, right? So if I can earn 9% returns on a treasury bill, I'm not going to go invest in Microsoft stock at 10% because the risk in Microsoft stock is much higher than treasury bill. I much rather stay with the safer option. So the risk profile, as we talked about, this is idiosyncratic risk needs to get compensated for. The other part of it is that the stock market as a whole might fall. So I need to get compensated for the, so maybe I dial it up to 10%. So it's a subjective thing, but it's a subjective thing which is measured, which is pegged to other fundamental measures of volatility in the economy. But if I know all these three numbers, then determining what the fair price of the stock is fairly straightforward. 1 year from now, I'll receive a 60-cent dividend. I can sell the stock if I want to at $32. So 1 year from now, the total proceeds from owning the stock would be $32.60. And at a 10% return, that's the relevant discount rate I'm applying to them, the fair price of the stock today is $29.64. Based on my expectation on how the stock will perform, I think if I can buy the stock for $29.64, then I would make a 10% return on my investment. And you can see straight away where that number comes from. 60 cents from the dividend, $2.36 from price appreciation. So on your $29.64, that's a 10% return. Right. Okay. So if you can come up with this number and then you go into the market and you are valuing this at $29.64, and you go into the market and the current trading price is $25. What should you do? Well, fairly straightforward idea there, right? You think it's worth $29.64. You are willing to pay up to $29.64 in order to get this stock. But if the market is willing to sell it to you for $25, then great. That's amazing. So if the market price is less than the fundamental value that you ascribe to the stock, then it's an automatic buy. You buy the stock because you think it's worth $29.64. The other people in the market think it's only worth $25. You buy it at $25. And if you're right, you will make more than a 10% return, because the $29.64 price that you're ascribing to it is under the assumption that the required return to equity is 10%. But if you are able to buy this for anything less than that, then your return on equity is higher. Okay. But even though I put these numbers down, it's very easy to plug these in, and you might gives you a false sense of security that you know how to price stocks. The point is that all of this is done in expectation. All of this, there's a lot of uncertainty surrounding these things. Okay. So when you're investing in stock for 1 year, you basically need three pieces of information. What is the expected dividend 1 year from now? What is the price that you think the stock will trade at 1 year from now? And what is the required return on equity? If you know these three things, then the stock pricing equation is fairly straightforward. The price of the stock today is the present value of the cash flows that the stock will generate into the future. So if the future is limited to 1 year, is the present value of the dividend issued in 1 year plus the price at which I can sell the stock 1 year from now, and you discount it back to the present by the required return to equity. Okay. So the superscripts that I put here on top of these things, this is basically that there is uncertainty around them. That's all done in expectation. I'm expecting a dividend of this much. I'm expecting the stock price to be this much. RE, if you notice, I didn't put an expectation there because why? Because that is more or less a subjective discount rate I apply to these cash flows. You can choose it whatever it to be, but you have to be sensible. Okay. All right. So if I had to think about the return I would get from investing in a stock, it consists of two parts. Okay. I have an initial price. This is the price I pay to own the stock. And I could earn returns from the stock in one of two ways. In one of two ways. The first way is that I get a dividend payment. So the expected annual dividend over the price I paid to get the dividend, plus the expected change in price. So this is the price in the future, the expected price in the future, minus the price I paid for it over the price I paid for it. Okay. So this portion of it is what we call the dividend yield. Right? The dividend yield is the expected annual dividend divided by the current price of stock. So if I buy the stock for this price, it's the dividend. So this is the yield I receive from receiving the dividend. Plus, this is what we call the capital gains. Right? So I pay this much. This is how much I get for it. The difference is a capital gain, because on my initial capital outlay, this is the additional capital I receive. So that's the capital gains. So if you, for instance, if you purchase a share for $30, so that's the initial purchase price, and dividend is 60 cents, and the stock price at the end of the year is $33, then the total return on the stock is the 60 cents that you receive over the 30 initial price. So this is your dividend yield, and the capital gains here is 33 minus 30, which is over 30, which is 3 over 30 or 0.12. So if you add both of these two up, so you get 12% of it. Okay. And you can see that most of it is carried over from the capital gains portion of it. 33 minus 30 is 3, 3 over 30 is 1 over 10. So 10% of your return is from the stock price appreciating in value from $30 to $33. And the other 2% that you're receiving is from a dividend yield of 2%. Okay. So when you think about the return on a stock, you need to make sure that you take into account both sources of value from stock investing, the dividend yield and the capital gains part of it. Okay. Now, so there is a big debate, not that much anymore, but there's an ongoing debate uh, in this literature around how should the proceeds from these stock investments be taxed. Okay. Dividends are what is known as subject to double taxation. Okay. What do we mean by double taxation of dividends? Dividends are taxed both at the firm level and at the individual level. What does it mean? So before the firm can issue any dividends, right? If you know your corporate finance, right? So you start with revenues, that's what the firm makes, right? Then you subtract the cost of goods sold, and then you arrive at the earnings before interest and taxes. Then you make all your interest payments, because interest payments are shielded from taxes, and then you arrive at your taxable income, the EBT, the earnings before taxes. Then you pay taxes, and that's when you arrive at your profit. Okay. Now the earnings of the firm are then therefore taxed at the firm level. So because you're receiving after tax profits, so because you're part owner of the firm, the firm that you own stock in is subject to the corporate tax rate. So your dividends are taxed at the corporate tax level once before they come to you. Once they arrive in your bank account or in your stock market portfolio, at the end of the year, you have to declare all the dividend payments that you got from your stocks to the government, and in which case there's the individual personal income tax rate which is applied to it. So the same flow of funds, the funds which were first subject to taxation at the firm level, is again taxed at the individual level. And this there's a big literature around it that might reduce the incentive, because we not only care about profits, and we care about after tax profits, right? So that might, if your after tax profits are reduced, that might reduce the incentive for investors to buy stocks, right? And give an incentive for firms to just retain a larger and larger portion of the profits at the firm itself. So instead of issuing a dividend and paying taxes twice on it, you might tell the firm, don't issue any dividends, just use the money, use the profits to invest in other things. So that keeps the stock market price going up, and you'll earn your returns that way. You don't want to receive a dividend and pay taxes, income taxes on it. You just want the firm to continue to grow, and as the firm continues to grow, the price of the stock that you own is also continuing to rise, in which case your capital gains is you're going to have much more significant capital gains, right? So the second part of this issue is that, okay, so if that is what investors end up doing, what is the problem with that? The problem is, of course, that if there is also a capital gains tax rate, right? If there's a capital gains tax rate, that might reduce the incentive for people to sell stocks which have accumulated significant capital gains, right? Because you're going to basically incur a big tax bill from selling these um, assets, because the prices have gone up significantly, and you might have an incentive to just leave them as they are, and that brings in this lock-in effect. So all of this wealth that on paper you have, right? Your stock market portfolio has grown significantly, but you're less willing to extract some of that and use it for consumption, because if you try to sell some of these uh, assets which are part of your stock market portfolio, particularly assets which have had significant capital gains, you also incur a significant tax bill. Okay. So these are attendant issues in how to tax these stock market investments. The first problem is, of course, the double taxation, that the dividends are taxed both at the firm level and the individual level, and that reduces the incentive for investors to want to get dividends and instead bloat these companies into by retaining most of the earnings into the firm, and the firm might use this money to invest in other investment projects which might not be that great to begin with, but they have the cash burning in the hole in their pocket, and they find new investments to pour that money into, and that might not be a great thing after all. The second thing is the problem with the lock-in effect, where all of this wealth is generated on paper, but investors might be less willing to extract some of this, sell some of these, especially ones which have incurred high capital gains, because they don't want to realize a big capital gain tax bill, right? All right. So in 2003, this is the second Bush tax cuts. Congress reduced the tax rate from 35% to 15% on tax dividends, right, and capital gains. So essentially realized that this might be a problem, and that's what you generally see, right? The On the one hand, that mitigates the two issues we've talked about, right? The tax rate is lower, so that reduces the incentive for these lock-in effects and for people to be unwilling to receive dividends. But at the same time, it increases income inequality, right? Because if you realize who is invested in stock market, who is heavily invested in stock market, these are already very wealthy people. So you are taxing really wealthy people in the economy at a lower rate than retail investors who, for whom most of their income is coming from wages, right? So if you have a passing interest in the subject, Piketty's book, Capital in the 21st Century, basically boils down to this argument, right? So the really wealthy in the economy, most of their wealth is not from wage income. Most of their money is not coming from going to work and earning wages. Most of their money is coming from investments. For the middle class and the less well off, most of their income, the huge proportion of the income is coming from wage income. They don't have massive investments. They have to go work a job, they earn money, and they have to pay. Now, if the tax rate is on wage income is higher than the tax rate on investments, that already in a already unequal system where there's really wealthy people and really poor people, now you have a double whammy. The really poor people are paying higher effective tax rates than the really wealthy people, who are basically most of the money is in the tax in the form of capital gains or on dividends, right? And so the trade-off is obviously, again, in 2017, Trump also passed big tax cuts, again lowering the capital gains tax rate and the dividend tax rate significantly. But the tension here is between efficiency and equity. On the one hand, on the efficiency side of it, if you reduce the tax rates on capital gains or on dividend payments, it incentivizes firms to issue more dividends and for people to sell some of these assets which have incurred high capital gains and use that money to spend in the economy, right? You boost consumption spending, and then if the consumption spending goes up in a significant way, it boosts aggregate demand in the economy, and that's a good thing for on an efficient point of view. You much rather have people use the money rather than just let it sit in the stock market portfolio and never take it out, because it keeps, if they take it out, they incur a big tax bill. On the other side, there's the equity argument, the argument I've already talked about, that you have a situation, a perverse situation, where the already very wealthy end up with paying an effectively a lower tax rate than the middle class and the less well off. Debate still rages on this issue right now, but I just want to tie it into why these things matter, right? When you see discussions around tax policy, it might seem mundane and very archaic, but the point is that it has a real effect on what kind of societies we end up creating. All right. So given all of this, then we know straight away how to value what is the fundamental value of a stock. right? We talked about how to value stock for 1 year. Now we can talk about it in a more general sense. We're not invested in just 1 year, right? Suppose you want uh, uh, to purchase a stock and stay invested. Your investment horizon is 2 years. So what do you need to know the fair price that you should be willing to pay for the stock? You need to know what the dividend payment will be in year one. You need to know what the dividend payment will be in year two. You need to know what the expected value of the stock will be in 2 years from now, and the required return to equity. So if you know these, if you're able to project the dividend payments and you have a expectation on what the price of the stock will be 2 years from now, you can come away with what we call the fundamental value of a stock, right? And suppose you're not interested in selling it, you don't want to artificially limit your investment horizon, you will be invested for the infinite future. All you need to know is this stream of dividends, right, into the infinite future, and you discount them appropriately. Obviously, this is 2 years from now, so that's why it's discounted by 1 plus RE squared, and that's also 2 years from now, so it needs to come back 2 years, so you get the discounted value. Okay, so the fundamental value of a share of a stock is the present value of all the dividends that are expected to be received into the indefinite future, right? Now, based on this, there is a stock market valuation equation, which is what we know as the Gordon growth model. The Gordon growth model essentially says, if you know the dividend today, and if you can project the growth rate of these dividends. So the only moving part, the elegance of the Gordon growth model is that instead of having to project every single one of these dividends and without a huge degree of error, which is a massively cumbersome process, how do I know what the dividend of Apple stock is 20 years from now to put it into this equation? How do I even come up with that number, right? The Gordon growth model says, okay, forget all about that. You know what the dividend today is, right? There's no uncertainty around it. This dividend is in your pocket today. All you have to form is an expectation on the growth rate of this dividend, right? On a year by year basis, if you think that there's a constant growth rate of these dividends, which is not a unsound assumption in the short run, because dividends don't fluctuate all that much. Because if you fluctuate your dividend too much, investors get spooked a lot, right? One quarter you issue a dividend of 80 cents on a share. Next quarter you cut the dividend to zero. The third quarter you show a dividend of $1.20. People don't like this much volatility in dividends. So once you show dividend, generally firms try to stay at that level. They might increase it. Increasing the dividend is fine, but they don't try to decrease it too much. They might decrease it, but also by a small amount. Okay, unless the situation gets so bad that they have to decrease the dividend significantly. But if that's the case, there's basically a geometric progression. So the fundamental price of the stock then is the dividend today times 1 plus G, where G is the projected growth rate on the dividends, over RE minus G, right? The derivation is straightforward, but it's beyond, it doesn't really matter, to be honest. So it's an infinite geometric progression. That's basically what you're, where this comes from. So if you take this equation and replace this with dt times 1 plus g, and then this with dt times 1 plus g square, and this with dt times 1 plus g cube, and so on and so forth, you essentially arrive at this pricing equation, right? This is just the sum of an infinite geometric progression. So if you know your geometric progressions and you know how that formula works, that's great. But for the purposes of our discussion, all you need to know is how to apply this Gordon growth model. Okay, so key features of the model is, first, we are assuming a constant growth rate in dividends. Might be problematic, might be might work much better in the short run. Definitely will work better in the short run than the long run. But if we are able to project that, that's great. So we have that number, and that's it, right? The other thing that it measures is obviously that for this to be a positive number, for this price to be a positive number, dt here is positive, g here is positive, 1 plus g is going to be positive. This comes down to re minus g, right? So if re is equal to g, then this entire thing goes to zero. If re is less than g, if RE is less than G, if the return on equity, required return on equity is less than the growth rate in dividends, then this becomes negative, and that is a problem, right? So the required rate of return must be greater than the growth rate of dividends. And the investor's expectation of the future profitability of firms, which is to say, that's how you essentially form expectation on G. That is basically the crucial determinant on bond pricing. So for instance, the price of a stock which has an annual dividend of 60 cents, so it has annual dividends of 60 cents, and the expected dividend growth rate is 7%. Now, if you ask me where does the 7% number come from, good question. That's why stock analysts exist, and that's why Wall Street exists, because different people are going to come up with different numbers on what that growth rate is going to be, right? Based on technical analysis, based on studying macroeconomic trends, based on studying the firm's business and competition, and running SWOT analysis and moat analysis and what all those manner of things. But suppose you are putting that number at 7%, then the fundamental value of the stock is fairly straightforward. You should be willing to pay DT, which is 60 cents, which is the dividend, times 1 plus G, 1 plus 0.07. Given that the required return on equity is 10%, then the fair price, the fundamental value of the stock is $21.40. Okay. All right. So I just want to run through a couple of examples to show you how to apply the Gordon growth model in a couple of different situations, and then we'll close this section on stock market valuation. Okay. So let's take a look at each of these situations. The first situation is fairly straightforward. So the annual dividend here is 40 cents per share. Dividend expected to grow at 7% per year. One thing to recognize is that this is annual, this is per year, everything is on the time spans need to be matched, right? Okay. And the required return on equity is 10% per year. Okay, so then you just apply the Gordon growth model, and the fundamental value of the stock is DT times 1 plus G over RE minus G. DT here is 40 cents, G here is 7%, RE is 10%, and then you plug that in and you get $14.27 as the fundamental value of GE stock in that situation. Second situation is slightly different. IBM stock was at trading at $155 per share. At the time, IBM was paying $5.60 in dividends per share. Annual dividend was $5.60. The required return on equity is 10%. What is the growth rate? So we want to know what G is, given all the other numbers. So we just plug everything in. So 155 is the current price. $5.60 is the dividend. 1 plus G. G we don't know. And required return on equity is 10%, 0.1 minus G. You just, take this to the other side. So 155 times 0.1 minus G is $5.60 times 1 plus G. You solve for G, and then you get the number as to what. So investors were expecting an annualized growth rate of about 6.2% growth in dividends year on year. Okay. So again, even though the fundamental growth model, Gordon's model, is a workhorse model which is used right now all the time, you need to recognize that it has two key vulnerable points. Even though it's better, it's more elegant than trying to project dividends into the infinite future, and instead just try to figure out what the growth rate of dividends would be. We are assuming firstly a constant growth rate year on year, which is okay in the short run, very problematic in the long run. But given that if you're able to come up with just predict that one number with some level of accuracy, then the rest of the model just tells you what the fundamental value of the stock is. Okay, stock valuation is more complicated than this, obviously. Otherwise, it wouldn't exist. Hundreds of thousands of jobs for people to just do stock market valuation. But on a fundamental theoretical basis, it's not very complicated, right? Again, remember, just the price of any financial asset is the discounted value of the cash flows that the asset generates. Okay, same goes for stock market. All right. So in the last part of this lecture, of this session, we will talk about the efficient market hypothesis, what it has to say about stock markets, and then we'll talk about how this hypothesis, which is, as I should stress, is still a hypothesis. The empirical evidence on the efficient market hypothesis is scant when available, and less than persuasive even when it is. Okay, but on a theoretical basis, it makes a lot of sense. Okay. At its very core, we need to, before we understand the efficient market hypothesis, we need to understand the fact of that expectations play a major part. Expectations on the future not only affect what happens in the future, but affects changes behavior today, right? That's the fundamental principle of economics in general. Now, there is two models. The older model is what we call adaptive expectations. The new model is what is known as rational expectations. This is how theoretically we model how people make their mind on what the future holds. Adaptive expectations is this notion that people make forecasts on future variables by looking purely at past variables. Okay, so if I want to know what is the future of real GDP, I look at the past values of real GDP. If I want to know what the future price of the Apple stock will be, I look at the past prices of Apple stock, and from that try to infer or form an expectation on the future price of Apple stock. Rational expectations, on the other hand, is a more encompassing idea. It says that people not only look at the past values of that variable, but look at all available information, right? Using all available information. So if the actual forecast, actual realized price, so you make up an expectation that this is what the price will be in the next uh, a year from now, that's the expectation. And if this is the actual price, this is the realized price, the difference between those two is the unforecastable error, right? We can't know what the size of that error is going to be, but the name of the game is to minimize the size of the unforecastable error, to keep that as small as possible, which is to say that our expectations need to converge onto the real deal. Okay, usually we are not going to be so precise. It's very, very difficult for this to be zero, but we can employ a whole degree of techniques in order to make this as small as possible. And the smaller that is, the more refined the estimate itself is. Okay, so the efficient market hypothesis, first, it takes this rational expectations framework to financial markets, where it says that investors in financial markets, okay, take into account not only the past value of the variable that they're looking at, but also using all possible publicly available information in order to make up their mind, which is to say that in the long run, that the equilibrium price of a security should be equal to its fundamental value, right? In some periods, the price might be higher than its fundamental value. Some periods, the price might be lower than its fundamental value, but it's always tending to converge towards its fundamental value, towards its fair value. Okay, so for instance, here's an example of how the efficient market hypothesis views the market. So it's 10:14 a.m. Monday morning. Price of Microsoft stock is $32 per share, $32.10 per share. That's what the stock is trading at Monday morning. Dividend of 90 cents per share, and then expected to grow at 7%. This is basically what the old equilibrium is. Based on this, you can, based on this information is what you've come up with $32.10. Okay. Now 10:15 the same morning, new information arrives. Microsoft releases new sales information that the latest version of Windows is expected to sell more than expected. Investors immediately respond to this by revising the forecast of the growth rate of dividends from 7% to 8%. Present value of future dividends. So, if you, instead of 8%, 7% growth rate, if you put in 8% into the Gordon growth model, it tells you that the fundamental value, the present value of future dividends from this owning Microsoft stock rises from $32.10 to $48.60. Investors with rational expectations look at this and say, the price of the stock is $32.10. It should actually be $48.60. Given that the new information has become available, they start buying Microsoft stock. And there should be an increase in demand for Microsoft stock. And how long does the demand keep surging till the price goes into equilibrium at $48.60? Okay. So self-interested actions of informed traders cause all this available information to market to get priced in, get incorporated into market prices. And this is a very elegant way of visualizing what we think is happening in the stock market. So every single second of every day there is some new information about this business, that person, that other business, and that basically alters the fundamental value of the stock because it revises the growth expectations on the dividend upward or down. If it gets revised upward, then the price of the stock needs to move up, and rational investors who participate in this market bid up the price of that stock till it hits its fundamental value and goes into equilibrium at that new price. If the revised expectations are lower, then the price of the stock needs to fall. So the demand for the stock needs to fall sufficiently so people start selling. Either the supply increases or the demand falls, such that the price of the stock will reduce to that lower level. And reasonable seems like a great uh, framework to apply, and that kind of explains why there's movements in the stock. So the efficient market hypothesis says that there is price movements in these stocks purely reflecting the fact that new information is becoming available, and then rational investors who participate in this market are reacting to this new information, and the price is always efficient because the whatever the new price is basically capturing all available information that on that particular stock. Okay. Now, if this is true, then there is no room for financial arbitrage in a financial market. Okay, because if this is the case, where the stock price is at $32.10, when the fundamental value based on this new revised expectations is $48.60, this opens up what we call a financial arbitrage opportunity, because you can buy that at $32.10 right now, right? Immediately try to buy as much as $32.10, and you know that other people are going to react to this news, and at some point the price of the stock is going to rise to $48.60, at which point you sell the stock and you can realize what we call as arbitrage profits, right? So if there are rational investors in the market, this arbitrage opportunity, as soon as it opens up, as soon as an arbitrage opportunity opens up, it immediately gets dissipated because rational investors rush in order to realize arbitrage profits. So there, for a brief moment in time, some investors are going to realize arbitrage profits before the arbitrage opportunity is closed off. Okay, so that's the idea, because stock prices are always reflecting all available information on the fundamental value. Anytime there is new information, any material new information which affects the fundamental value of the stock is released, straight away we have changes in the fundamental value. And as the fundamental value changes, that drives demand and supply for these stocks, and in turn that is what alters the price of these stocks constantly. Okay. Then the question becomes, what about inside information? How does the efficient market hypothesis account for inside information? Inside information is information which is not known publicly, right? Not all market participants know it. Some people who are on the inside of the firm might know more, because again, insider information is basically a version of asymmetric information, right? Because people who run and work at the firm and operate the finance of the firm obviously know more than you and me sitting at our homes and looking at the stock price, right? So if they're able to pass on this information to only a few of us, right, which is what insider trading, inside information is, uh, which is illegal, and there's a lot of high profile people who've gone to prison for doing insider trading. Uh, this a strong version of the efficient market hypothesis says that's not a problem. Why is it not a problem? Because you might have inside information. Based on that inside information, you start making moves, right? As soon as those moves start happening, other investors in the market who are observing the stock look at it and say, based on the information we have, the fundamental value of the stock has not changed. So if this is changing, it means that somebody knows something more than I do, and they start reacting in the same way as the person who's making these moves, and then the arbitrage opportunity disappears. That's a very, very strong assumption, because it relies on the assumption that other financial market participants are able to recognize this straight away and recognize this as insider information, credible insider information, and move with it. And that's really problematic, because a lot of money has been made based on inside information. And there's reason for why when people find it, it's severely punished and people go to prison for it, right? So a key implication of all of this discussion around the efficient market hypothesis is that stock prices are not predictable, right? You can't tell where the stock price will be tomorrow. You can't even tell where the stock price will be 10 minutes from now. Why is that the case? The stock price based on the efficient market hypothesis is purely tied to changes about the fundamental value of the stock. Any information which can hit the market which changes the fundamental value of the stock is going to change uh, the price of the stock, and then what information hits when is not predictable in certain sense. So price that is currently the stock is trading at reflects all available information, both public and private, in the stronger version of the EMH, the efficient market hypothesis, if you want to be fancy, uh, is reflected in the price of the stock today, right? So rather than modeling stock prices as somehow predictable, what we generally model stock prices as that they follow what we call a random walk. Random walk essentially says that the stock price today is going to be the stock price. Okay, the stock price 1 minute from now is going to be the stock price 1 minute before, plus minus some drift. Okay, so there's going to be persistence that the stock price in the next minute is not going to be radically different than stock price a minute before. It's going to drift. There's going to be positive drift and there's going to be negative drift. Sometimes the stock price will move up from where it is right now a minute later. Sometimes the stock price will move down from where it is now a minute later. But the direction of the drift is not predictable. The size of the drift is not predictable either, right? So random walk essentially says that the movements in these stock prices are basically fundamentally unpredictable, and the only thing is that it's persistent. There's persistence in the time series, which is to say stock price in the next moment is the stock price in the previous moment plus some drift. Okay, so a strong assumption of strong uh, result that emanates out of the efficient market hypothesis is that, okay, fundamentally stock prices are unpredictable. The price at any given point is efficient. That's the reason efficient. The price is taking into account, is incorporating all publicly available and privately available information into it, and there is no financial arbitrage opportunities which open up. And if a financial arbitrage opportunity opens up when some news hits and the fundamental value of the stock is changed, and the financial arbitrage opportunity opens up, investors who have rational expectations rush in order to bid up the price of the stock or bid down the price of the stock, such that that arbitrage opportunity closes swiftly, almost instantaneously. In an efficient market, that arbitrage opportunity closes instantly, right away. Okay. So the efficient market hypothesis, if you believe this is true, then it gives us implications for portfolio allocation, right? The efficient market hypothesis says that given the fact that the price of any given stock is fundamentally unpredictable, the only game in town is to hold a diversified, broad portfolio of a wide array of different stocks, right? So this essentially is a way of saying that you minimize the idiosyncratic risk associated with being invested in one particular security, and rather than that, you basically hedge your bets and spread your risks on the broad basket of securities and form a portfolio which is diversified in that. Okay. The second key implication is that trading, especially because it has both implicit and explicit costs. So when you think about trading, there are explicit costs. So nowadays you have these zero fee brokerages where you can trade a lot wide array of stocks for free. So there's no explicit cost to trading frequently, but there is implicit cost because you need to constantly be monitoring it and constantly taking into account what new information is coming in and how it affects the fundamental value. And if it affects the fundamental value in a meaningful way, then is the analysis sound? And if it's sound, if you expect a financial arbitrage opportunity to open up, to leverage that and to take advantage of it and to do all of this, and it takes a lot of effort to do it. So net of costs, both the implicit and explicit costs of trading, it might be better to buy and hold a broad diversified portfolio of stocks for the long run rather than churning a portfolio by moving funds repeatedly between different stocks, right? That's the key implication of what the efficient market hypothesis has to say about it. Okay. So the efficient market hypothesis it says that you get every single day that you go on the internet and you'll have some person out there telling you this is the next hottest trend, this is the next stock to buy, that thing or the other thing and the other thing. The point is that if the efficient market hypothesis is to be believed, the UMH results hold up, then the price is already reflecting all of that information, right? The price is reflecting all available information. So it's a fool's errand to try and uh, outperform the market in that sense. So buying index funds, which are a broad, well-diversified portfolio of stocks, seems to be a better strategy. And Burton Malkiel, who wrote a magisterial book called A Random Walk Down Wall Street, is a professor at Princeton, an unbelievably well-informed book. So if you are interested in it, you should take a look at the Random Walk Down Wall Street. Has this nice little quote from his book that I have here, where if you take the image to its logical extreme, then a blindfolded monkey throwing darts at a newspaper's financial pages would select a portfolio just as well as any selected by the experts, which is to say that pure chance, a portfolio selected by pure chance is no better, has an equal chance of doing as well as a carefully selected, curated portfolio of stocks, right? The name of the game is diversification, is not, and that's the logical extreme, but the name of the game is about diversification, but there is gradations on how to do diversification. You can be poorly diversified and well diversified. The crucial element here is to be well diversified, right? You can just buying a bunch of different kinds of stocks is not, it's diversification, sure, but it might not be the most well judged, well founded diversification strategy there is. Okay. So question then becomes, if the image holds and the stock prices basically follow a random walk, and if the stock market prices are fundamentally unpredictable, why do you even want to be invested in the stock market, right? So if you look at the financial crisis of 2007 2009, between October 2007 and March 2009, the Dow dropped over 50%. We saw that in the graph previously, and the value of mutual funds held by households declined by almost $2 trillion, right? About $2 trillion of household wealth was wiped out over the course of a few months, right? Now, given the historical track record that there's a lot of volatility and there's these periods of severe financial distress where in a matter of months, years worth of wealth creation can get wiped out, and the fact that the stock market is fundamentally unpredictable, if we go by the results of the EMH, why do we even want to invest in the stock market? And the answer is very simple. The answer is that the returns that you get on the stock market, once is adjusted for the risk associated with investing in a broad array of the stock market. Now we're talking about index fund investing. It is not about investing, trying to find the next Apple or the next Tesla or the next whatever it is. But if you're holding a broad index fund of stocks as part of your investment strategy, the returns over the long run are very different. And almost all of this effect is driven by compounding. Okay, so CDs, a certificate of deposit, which is a 1.5% annualized rate of return. So we are talking about, this is basically if you run through a spreadsheet where you're investing $100 per month beginning at age 22, right? So at age 45, if you invested all of that money in just CDs, you would end up with $33,076. Treasury bills with a 2.5% yield will give you 37,429. Stocks on average, which have returned 10% on average, you would end up with $107,543. At age 67, as the first element is the fact that stocks have on average higher returns over the long run, right? So which is not to say the stock market is not volatile, which is to say that there's going to be periods where the stock market's on a huge upswing. There's going to be periods where the stock market crashes and burns. But the long run average of all of that is still significantly higher over other investment opportunities, right? 1.5% with CDs, 2.5% with treasury bills, 10% average returns on the stock market. So on the first sense, there is a high return, and this gets compounded the longer you hold for it. So at age 45, you would have 33,000, and that would go to 77,000 in this case by 67. But if you had the same amount of money, same investment strategy in stocks, you would go from $107,000 to $1,000,000, right? The investment strategy is still the same. You take $100, invest it in one of these three products every single month, from starting from the age of 22 till you hit retirement age at 67. And this is basically the crucial reason why, even though the stock market is volatile, even if the stock market is fundamentally unpredictable, a broad, well-diversified array, an index fund investing and strategy is going to yield significant positive results. Adjusted for inflation, these returns obviously go down, but still, the stock market severely overperforms other investment classes in the same time horizon. Okay. Okay. So we know these are the implications of the efficient market hypothesis. And the last section of this discussion, we will turn to the question of, is it really true? Can we go by what the efficient market hypothesis has to say? Are financial markets actually efficient? Okay. So let's start with the good news. What we have, if we run through the analysis and look through the empirical data and do statistical analysis, what we get here is that we have more than reasonable evidence to suggest that stock prices are fundamentally unpredictable. If we try to fit random walk models to the time series for stock price returns, that tends to follow random walk. It's fundamentally unpredictable, especially in the short run. It's fundamentally unpredictable. But the actual behavior of financial markets throws up a few uh, issues into this notion that financial markets are efficient. The first thing is about pricing anomalies. That efficient market says that financial arbitrage opportunities close very quickly. True, up to a certain extent. So pricing anomalies, there are periods where stock market prices have stayed much much higher or much lower than fundamental values for prolonged periods of time. It's not that a financial arbitrage opportunity dissipates immediately as soon as it opens up. It takes a long time, and people have used these pricing anomalies to generate above market returns. And the question is, if that is possible, then the market is not fundamentally efficient, and that's true. And there are a lot of examples where people have benefited from this. Okay. The second key empirical evidence we have is that some price changes, especially short-run price changes, can be predicted and can be predictable using available information, right? So the longer the horizon goes for the forecasting, the bigger the errors become. But on a short horizon, starting today, if I want to predict for tomorrow, the day after, the week, and the month after, it's possible with some precision. But again, throw some monkey wrench into the works that the prices are incorporating all available information, markets are efficient. Okay. The other key piece of evidence we have is this herding tendency in the stock market, where a financial arbitrage opportunity might open up, like we discussed with Microsoft at $32.60. News comes, fundamental value changes to $48.60, and the market reacts to it by bidding up the price of stock. The problem we have, at least, is that the efficient market hypothesis says what? The price should rise up to $48.60, and absent any other new materially significant information, should stabilize at that level. But that's not what we find. We find that the price overshoots quite more often than not. It overshoots and then corrects, and then keeps fluctuating quite significantly, and the price is fluctuating every single second of every single day, and materially new information is not showing up every single day. So what explains this? The efficient market hypothesis doesn't have uh, any answers to these challenges, right? Then there's all these empirically established results. There's a small firm effect. Okay. So again, empirically, we see this holds up. The smaller firm effect says that if you invest in a portfolio of small cap stocks, right, firms which are very small, they tend to outperform, yield a higher return than investment in larger cap, right? This small versus large differential, and that can be that, that tells you that you can't, like, in a well diversified portfolio strategy, we can't just have large cap stocks. You might also want some exposure to small caps for the fact that they have higher returns, but these are pure returns. These are not risk adjusted returns. So small firms generally tend to carry higher risk because they are small firms, so they are at a greater risk of being in financial distress and going bankrupt. So that kind of, once you account for the riskiness of the smaller stocks, some of these effects, some of these larger returns dissipate. Risk adjusted returns, in terms of risk adjusted returns, that gap narrows, but there's still a gap there between small versus large. January effect, there's a seasonality, that, when the new year rolls around, people feel a little bit more optimistic. There's make resolutions about being more prudent about retirement saving, whatnot. You see big moves in stock markets in January. And again, efficient market, if markets are efficient, you shouldn't have any of these effects, and the January effect is well documented. Pricing anomalies like this are inconsistent with the efficient market hypothesis for several reasons, right? One is data mining. Data mining is essentially, it says that we can always, once we know how the data is panned out, once we know the historical data, it is always possible to construct a theoretical portfolio which will generate above market returns, right? It's always possible to do that by, it's Monday night quarterback, right? Risk, liquidity, and information costs. High returns on investments. This is basically what I already talked about with the small firm effect. The small firms will have higher returns because they have higher risk, lower liquidity, and higher information costs. So the higher returns that you're receiving in risk adjusted, liquidity adjusted, and information cost adjusted terms is going to narrow that gap significantly between small versus large firms. Okay. The other key element of it is trading costs and taxations, right? So if you have to follow this arbitrage opportunities, you have to trade a lot more, a lot of churn, and to trade all of that, you need like a lot of infrastructure, you need a lot of analysts who are doing all of this, and you need to pay them, and you have to take into account the tax implications, because once those to realize the arbitrage profits, you need to sell, and then that triggers capital gains and other tax liabilities. And once you take into account all of that, then the pricing anomalies, again, these might not be pricing anomalies after. Okay. There's two trends, however, that we observe that people have leveraged quite often. One is what is known as mean aversion, right? Mean reversion. So what is mean reversion? Mean reversion essentially views stocks as being somewhat like following a cyclical pattern like this, right? So if this is the long run mean, the long run average that you establish, and you can set the long run average to be the fundamental value of the stock. So if the efficient market, if you adopt a weaker version of the efficient market hypothesis, you can say that the price will converge, the fundamental value of the stock will converge to its long run average price. So there's going to be periods when the stock price rises, whereas periods when stock price falls, but the tendency of the price is going to be revert to the long run averages, to the mean. So if the stock price has risen for a long period of time, the chances are that there's a higher probability it will fall than will continue to rise, right? And if a stock has experienced low returns for a long time, there's a higher preponderance of the probability is on the stock market, stock price rise. Momentum investing is basically leveraging persistence in stock movements. So a stock which went up like in the last minute, the chances there's a slightly higher probability it will continue to rise and rise, because the surges in demand is reflecting changes in the price. And as long as the demand keeps coming in, the demand doesn't all come in all at one time, right? Different people are going to enter in the market, and the demand slowly it starts to trickle in and surge into the market. So if the price starts to rise and rise, you see more and more demand come in. There's also herding in momentum investing. So other investors who might not know anything about the stock just see the stock market, the stock price rise, and also flood into the market, increasing the demand in the market and raising the prices there as well. So that's basically momentum investing. So momentum investing is on this path, right? If this is what's happening, you're saying that it'll continue to happen. Mean reversion says that if this keeps happening for a long time, then the preponderance on the of the probability is on the fact that in next period you're going to have a decrease in the stock price. Okay. So what do we learn from all of this? So the efficient market hypothesis says that fluctuations in stock price should reflect the fluctuations in the fundamental value. If some materially important things change the fundamental value of the stock, then that changes the demand or supply for the stock, and based on the changes in demand and supply for the stock, the price goes into equilibrium at a lower or a higher price, right? Robert Shiller, who won the Nobel for all his work in behavioral finance, points out that stock prices, the fluctuations, if you look at the actual fluctuation, so if you follow this and say, okay, this is the fundamental value, that's not what has happened. The fluctuations have tend to be larger, have tend to be magnified, right? Much greater than the fluctuations in the fundamental values. So if that continues, there is an arbitrage opportunity, right? Because there is a tendency to overshoot and undershoot targets constantly, because the price keeps doesn't converge exactly to its fundamental value and stabilize there. It just keeps moving around and overshoots the fundamental value, undershoots the fundamental value constantly. You can use that to earn above average returns, and you can, and people have done it, but only for short periods of time, right? You can't consistently, no firm has ever managed to consistently beat the market for decades on it, right? Without dialing up on some other things, right? If you ever see a firm which says, okay, we've beaten the market 20 years in a row, that's a bit suspect, okay? The only way you're beating the market 20 years in a row is two ways, two obvious ways. There's more than two ways, obviously. Two obvious ways. One is that you are carrying more risk than the market level risk, right? The riskiness of your portfolio is obviously higher. That's why you're earning above average, above market returns. Makes sense. Or you're dialing up leverage, right? So the discussion on leverage and how it affects returns on equity is beyond the scope of an introductory class in money, banking, and financial system. But if you take a course in asset pricing, you will see a lot of why leverage plays into how it affects returns on equity, how it can magnify those effects. So let's return to the fundamental question then. So during the 2007-2009 financial crisis, the stock price of a lot of companies fell dramatically. So is the question, then the question is, does it mean that the fundamental values decrease? Okay. The argument so far has been about G. In the Gordon growth model, we are saying that if new information comes in, which affects our expectation on what the growth rate of dividends will be, that will change the fundamental value of the stock. What we've left out of the discussion is in the Gordon pricing model, on the denominator, we have this other element called RE. Okay, RE minus G. So even if fundamentally the business has not changed, right? If you look at the Gordon growth model, it's the DT times 1 plus G over RE minus G. So suppose your expectations on G have not fundamentally changed. But if you dial up RE, if this RE goes up, the denominator is getting larger, the numerator stays constant, which means that the value price of the stock falls. So during times of financial distress and crisis, the required return on equity gets dialed up significantly, because the required return on equity is taking into account, as we talked about, both systematic and unsystematic risk, both systematic and idiosyncratic risk. In periods of severe financial distress, not only is idiosyncratic risk getting dialed up on individual companies, so is the systematic risk, because the entire market is affected as a whole. As a consequence, the return on equity, required return on equity gets dialed up. So if the required return on equity gets dialed up, even though in a fundamental sense, the business proposition of the firm has not changed, it can dramatically lower the price of that stock. Okay. So during the financial crisis, we have a double whammy. We have a double whammy where required return on equity is going up. At the same time, growth projections are falling. So the growth rate, dividend growth rate projections are declining. So you are having a double whammy. So G is falling, RE is increasing, RE minus G falls even more. Right. So it's further exacerbate. Yeah. Okay. So there is a whole body of literature now devoted to understanding. Okay. Given the warranted skepticism around efficient market hypothesis, wild swings in the stock market that we see are at odds with all the predictions of the efficient market hypothesis. And so there is a whole body of literature which delves into the psychology of the investors, right? About loss aversion. So if you're interested, Danny Kahneman, who won the Nobel again, was a psychologist, but he did a lot of work in studying economic behavior, as a great book called Thinking Fast, Thinking Slow, where he pinpoints all of these things that uh, most most people in this world are limited by what we call bounded rationality. That rationality is not infinite, right? Like people can be rational in certain for certain periods of time in certain situations, but that's not persistent and that doesn't continue for the long run, right? Rationality is bounded in the sense that people don't behave as perfectly rational actors. There's imperfect rationality. So as soon as you introduce non-rational actors into the system, the efficient market hypothesis basically falls apart very quickly, because the efficient market hypothesis at its very core is applying the rational expectations framework to understanding financial markets. So if you take away the rational expectations from the model, then the other edifice of the efficient market hypothesis starts to fall apart fairly quickly. And that's what behavioral finance tends to do, right? They come up with these new theories and suggestions and frameworks to think about why there is these wild swings in these markets. Okay. So at the beginning of this chapter, beginning of this discussion, we asked the fundamental question: does the volatility of the stock market affect the broader economy? Okay, and the short answer is yes, in an indirect way, right? If the stock market goes up, it changes the wealth of households, right? Consumer wealth is changed. If consumer wealth is changed, we know because of wealth effects, there is a change in consumption behavior, consumption saving behavior, and therefore through that channel, it affects supply and demand for goods and services in the broader economy. And in that sense, there's a broader uh, effect of the volatility in the stock market getting reflected in the broader economy. Okay. And that's where I won't close this discussion. The stock market is not the economy. The stock market is correlated with the economy. Changes in the stock market have ripple effects on the broader economy, but it is not one-to-one. Okay, the correlation is not perfect. There is a positive correlation between those two things, but the correlation is not a perfect correlation. Okay, so and that's where we'll finish this discussion. So if there's any questions, leave them in the comments below the video, or send me an email, and I'll see you in the next one. Thanks so much for listening, and have a good rest of your week.